Hello, welcome to Accounting with Arpit Garg. We were studying admission of a partner and we have already completed our first three topics. So today, let's understand reserves and accumulated profits or losses. Well, let me tell you, this topic is same in admission, retirement and death of a partner. So you can please prepare the notes because it is going to be very helpful in all the three chapters. Let's begin. First, general reserve. Now, reserve is, as we studied, part of our profit kept aside. And we have already studied that all incomes and gains are credited. It means general reserve has credit balance. Now, before the new partner comes, the old partners will distribute all these reserves among themselves. So, they will clear the balance of all the reserves. Now, as general reserve has credit balance, to clear it, they have to debit it. So, debit general reserve account. And as this is to be given to the partners, so we will increase their capital accounts. So, entry is general reserve account debit to old partners capital accounts, and this has to be distributed in old profit sharing ratio. Next, profits and loss account if it has credit balance. Now, credit balance means this account has profit balance. So, as it is credit, we will debit it. So, profit and loss account debit. Now, this will be shared by old partners in their old profit sharing ratio. So, to old partners capital accounts. Next, if profit and loss account has debit balance. Now, as the balance is debit, it means there is loss in this account. So first we will credit profit and loss account, and then as it is loss, it will decrease partners capital. So we will debit old partners capital account. Then deferred revenue expenditure. Its definition we already studied in 11th. These are the expenditures which will help us to earn revenue, but their burden is shifted to many years. So, as it is expenditure, it has debit balance. Now, to clear this, we will credit deferred revenue expenditure account and debit old partners capital account. Now, these were just the simple ones. Now, next is workmen compensation reserve. For this, we will prepare a chart. So, please get ready with your paper and pen to understand and pen down the concepts clearly. Before starting this, let me tell you that for workmen compensation reserve, we will write WCR in our notes, and for workmen compensation claim, we will write WCC. Now, what are these? In our firm, there are workmen who are working for us. Now, these workmen, if get any hurt or any illness or any disease in their course of business, we, the firm, will have to compensate them for that mishappening. And for giving the payment, it can happen anytime. So, the loss or the compensation can be given anytime when the loss will be. So, to get prepared for that, we prepare a reserve called workmen compensation reserve. And if that claim arises, means if that mishappening happened and now we are bound to pay the claim, that is called workmen compensation claim. So let's begin. First, we will check whether workmen compensation reserve is there or not. If workmen compensation reserve is not there, then we will check whether workmen compensation claim is there or not. Now, if workmen compensation reserve is not there, workmen compensation claim is also not there, then we will also not do anything. And if workman compensation reserve is not there, but workman compensation claim is there. Now we are not having any money, but claim has to be paid. So we will make a liability. So to workman compensation claim account. Now as we have to pay this is expense or loss for us. So we will debit the valuation account as studied in our last video. Now, when workman compensation reserve is there, we will see whether workman compensation claim is there or not. Now, if workman compensation reserve is there and workman compensation claim is not there, then we need not pay anything to our workmen. We are having reserve, that reserve old partners will distribute among them. So workmen compensation reserve account debit to old partners capital account. Then if both workmen compensation reserve and workmen compensation claims are there, then we will compare the amount of both. If we see that workmen compensation reserve is more than workmen compensation claim, it means we are having more money than that what we have to pay. So here first we will debit workmen compensation reserve as we are cancelling this or we are clearing this account. Then we will raise a liability. So to workmen compensation claim account. Suppose workmen compensation reserve is 10,000. Workmen compensation claim is 7,000. We are still left with 3,000 rupees and that remaining amount will be distributed among old partners in their old profit sharing ratio. Next, when workmen compensation reserve is equals to workmen compensation claim. Now first thing we will clear workmen compensation reserve. So we will debit workmen compensation reserve account. Then we have to create a liability. So to workmen compensation claim account, and as both the sides are equal, entry is done. Now if workmen compensation reserve is less than workmen compensation claim, so here also first we will debit workmen compensation reserve account. Then we will credit workmen compensation claim account. But as we see, the amount on the credit side is more, so we have balance left on debit side, and debit is loss for us, so we will debit the valuation account. Now please mark one point here that if the claim is accepted, then we will write workmen compensation claim. But if the claim is estimated, then we will write provision for workmen compensation claim, and this accepted or estimated will be clearly mentioned in your question. Next, investment fluctuation reserve. Now I need some more space for this, so let me just adjust this. Okay, let's begin. Now here also please mark that for investment I will write investment. For investment fluctuation reserve IFR. For book value of investment BV. For market value of investment MV. And for fall in value I will write FIV. Let's begin. First let's understand what is this. Suppose we have some extra money in our firm. So we invested that outside to earn something on that. But market keeps on fluctuating. So either we will have profit or we will have loss on that investment. But if that investment is incurring loss and we need money, so that will be a problem for us in our hard times. So to compensate that, we will prepare investment fluctuation reserve account. Now, before the new partner joins, we will distribute this investment fluctuation reserve among us, because this is the part of profit and this profit was earned with our old partners' effort. That's why this will be distributed among old partners only. But let's see How we will distribute this? So first we will compare book value and market value of investment. Whether in market the value of an investment has raised, has fallen down, or is the same. So if book value is equals to market value, which means we invested rupees 10,000, and in market the value of those 10,000 is 10,000 only, then there is neither profit nor loss. And here we are considering that in every case we are having investment fluctuation reserve. So as we are having reserve, as we are having the amount of profit, so old partners will distribute this profit among themselves. So investment fluctuation reserve account debit to old partners capital accounts. Now, if book value of investment is more than market value, which means in market price of our investment has fallen down and we are incurring loss, so we will calculate the fall in value, which is book value minus market value. For example, we invested rupees 10,000, but in market that investment cost rupees 6,000 today. So fall in value is rupees 4,000. Then we will compare this fall in value with investment fluctuation reserve. So if investment fluctuation reserve is more than fall in value, for example, fall in value is rupees 4,000, but in our reserve we have rupees 7,000. So we have rupees 3,000 more. Okay, first we will clear investment fluctuation reserve by debiting it. Then we will reduce the value of investment by crediting it with fallen value. And as we are having more balance left with us in our reserve, we will distribute that among old partners in their old profit sharing ratio. So investment fluctuation reserve account debit to investment account to old partners capital account. Next, if investment fluctuation reserve account is equals to fallen value, then here also first we will debit investment fluctuation reserve account, and then we will reduce the value of investment by FIV. So credit investment account. Now as both the sides are equal, the entry is completed. Next, if the value of investment fluctuation reserve is less than fallen value, which means the fallen value is 4,000, but we are having reserve only of rupees 3,000. Now here also first we will clear the account of investment fluctuation reserve by debiting it. Then we will reduce the value of investment by crediting it with fallen value, and then we will transfer the balance to the valuation account being loss for us. Now, what if the market value is more than book value? Which means in market our investment worth more than 10,000 now, according to our example. So as the value is increased, so we will find rise in value, which is market value minus book value. Now as the value is raised, so the reserve can be distributed among partners. So first we will clear the account of investment fluctuation reserve and will distribute this amount among old partners in their old profit sharing ratio. Then we will increase the value of investment by debiting it, and will transfer this gain to the valuation account. Now please mark one point here also, which is very important for all the topics we have studied till now in this video and the topic which we are going to study now. That is, if the firm follows fluctuating capital method, then we will write partners capital account. But if the firm follows fixed capital method, then we will write partners current account. Now, our last method. Sometimes partner decides to maintain these reserves, accumulated profits and losses at their original value in the new form. So they just pass a single entry to give effect to the transaction. Now how to pass that? Do we need to calculate sacrificing ratio? No, because this also we can do the same way we calculated our goodwill. Let's see how. First, we will add the amount of all the reserves and profits and will reduce the amount of losses. With that, we will get an amount which we need to adjust. Then we will prepare a table with particulars and names of all the partners. We will distribute the amount we got in old profit sharing ratio and then in new profit sharing ratio. We will deduct both the amounts and will get balances. Now, if we get balance as positive, then we will credit the amount, and if we get balance as negative, then we will debit the amount. That's it. We have completed the concepts of all the reserves. In our next class, we will start our last topic, which is adjustment of capital. Meanwhile, solve as many questions as you can to brush up the concepts. If you like the class, please like the video, subscribe the channel and press bell icon to receive all latest updates. This is Accounting with Arpit Garg signing off. Bye bye. Take care. Keep learning. Stay safe. Jai Hind.